Hello, my name is Sergei, and I invite you all to engage in a challenging journey. Over the course of an hour, we'll try to puzzle out the greatest technological revolution after the birth of Internet itself, that of decentralized finance, for short DeFi. We'll not only gain insight into the intricacies of the revolution, but we'll also learn how to enjoy its fruits, that is, to make our own fiat money work in DeFi and generate profit. A profit that is unimaginable in TradFi, traditional finance. I particularly want to draw your attention to the fact that we will not mess with gambling on the stock exchanges or elsewhere. The real DeFi has nothing to do with volatile securities or hyped crypto tokens, the so-called shitcoins. That type of amateurish buying high, selling low casino always ends up in losing all initial investments. At the very least, it doesn't deserve the title of revolution. We will deal exclusively with the crypto assets pegged to the United States dollar, so-called stablecoins. It means their price tends to follow closely the price of a greenback. Let's not indulge in illusions. There are plenty of risks in any financial endeavor, let alone investing in a brand new type of asset like crypto. But in the real DeFi, absurd volatility should never be our concern. Now let's take a look at our plan of action. The theoretical part of the express course, dubbed Alphaleaks DeFi, covers the following topics: the definition of decentralized finance and its role in larger cryptoeconomics, general knowledge and understanding of such terms and concepts as blockchain, cryptocurrency, crypto tokens, NFT, crypto exchange, crypto addresses, public and private keys, smart contracts, decentralized applications, dApps for short, the types of crypto wallets with their pros and cons. Next, we will learn the difference between DeFi and TradFi, the major trends in today's decentralized finance, the major types of income one can expect in DeFi, or to put it more bluntly, how to make money in DeFi, numerous risks in DeFi and the way to neutralize them. And last but not least, I will share with you an algorithm for choosing DeFi projects that are worth dealing with without incurring devastating losses, even in situations of irresistible force. The second practical part of our course consists of 3 short units. Unit 1. You will get step-by-step instructions on how to set up your Workspace, where to find all necessary information related to cryptocurrencies and exchanges, where and how to search for the most profitable DeFi projects, how to set up your Web3 extension wallet and connect it to a hardware wallet in order to start working with various blockchains and crypto networks in which DeFi smart contracts and dApps operate. Unit 2. I will demonstrate a step-by-step interaction with one of the most popular and time-proven DeFi projects, which belongs to the so-called yield farming optimization platforms. Unit 3. I will show you a step-by-step interaction with one of the loans protocols which allow lending and borrowing activity in DeFi. Following the release of Alphaleaks DeFi, we plan to produce regular updates which will complement and build on the present express course with step-by-step interaction guides for the newest, most promising and lucrative DeFi project. That's the TLDR of our video course. We will start with a short description of some basic concepts which we simply cannot ignore in the future practical work. Why so? Well, something tells me that you are not the type of audience that blindly follows tips from crypto influencers in Twitter and Instagram, at least not before you gain an understanding of what exactly you're doing and why. Part 1. Basics of Cryptoeconomics. Block 1. DeFi as a part of cryptoeconomics. DeFi is an abbreviation of decentralized finance. That is a segment of cryptoeconomics which opens for anyone who wishes to engage in financial relationships with counterparties without the need to obtain permission or license on the part of any bank, institution, or government body. DeFi allows anyone to act as a financial agent without going through any KYC, Know Your Customer procedure, which involves such doubtful stripping as taking selfies.
Driver's license, passport, utility bills.
What financial relationships are we talking about? Exactly the same as those always present in TradFi: lending and borrowing, market making on financial exchanges, taking out insurance and selling insurance policies to others, creating and trading derivatives, establishing hedge funds and acting as portfolio manager, and so on and so forth. The only difference between these activities in DeFi and TradFi is their inclusiveness. It means that in DeFi, the user doesn't need to ask anyone's permission to interact with any project. They are their own boss, and all profits go directly to their own pocket without the need to give away the lion's share to bankers, brokers, market makers, hedge fund managers, and insurers. At the same time, it is important to understand that the absolute inclusiveness also means absolute responsibility. In DeFi, you are your own banker, your own broker, your own insurer. That means that yours is not only the profit, but all the risks too. Risk to commit a mistake. Risk to fall across a scammer, to lose money, to overlook something important, to estimate an investment inaccurately, etc. Plenty of risks and big responsibility is definitely not for everyone. But for those who are still interested, I have some consolation. In DeFi, rewards for these risks are inconceivable in traditional finance, let alone that unique feeling of a breathtaking euphoria which you experience while interacting with sophisticated DeFi smart contracts. Since DeFi, as we already know, is a part of a larger cryptoeconomics, it's quite natural to begin precisely with it. In 2008, an anonymous person or entity nicknamed Satoshi Nakamoto created the first public blockchain in history, together with the first cryptocurrency Bitcoin. Since then, Bitcoin has become the most profitable financial asset of all times. The identity of the genius inventor is still unknown. The more Bitcoin grew in its dollar price, the more the technology itself grew in popularity. Within several years, hundreds of new blockchains and cryptoassets saw the light of day, counting tens of thousands as of today. Well, it sounds great, but it will become even greater if we understand what public blockchain and cryptocurrency mean. Block 2. Blockchain and cryptocurrencies. Public blockchain is a database which is decentralized and open. And as we know, a database is a collection of spreadsheets which logs information such as the relocation of various objects from one owner to another. Such relocations are known as transactions. Let's consider an example. A conventional bank's database contains information on its clients: names, dates of birth, home addresses, phone numbers, places of employment, income, money in the account, and all the transactions debiting and crediting that account. This bank database, like most traditional databases, is stored centralized and privately on a bank's server. It goes without saying that such databases have numerous backups, which are stored on different servers. However, all these servers belong to the same bank and are protected with passwords and proper credentials. To gain access to such databases, one needs special permission. The conceptual difference between traditional databases and a public blockchain lies in the fact that a public blockchain is completely open and decentralized. It belongs to no one, and everyone has the right to open it. Look inside and check the data stored there. In order to preserve a blockchain's immutability, its identical and constantly renewed copies are stored on thousands of computers all over the world. As I said, a public blockchain has no owner. It belongs to no one and at the same time belongs to everyone. No one has the authority or ability to close access to a public blockchain for others. None of the decisions related to the information stored on blockchain can be taken without consensus and approval from others. Anyone can download a copy of blockchain from the internet and run it on their own computer. We don't even have to download anything, just open a web interface and instantly gain full access to a public blockchain in real time. Computers storing identical copies of a public blockchain are interconnected in a network and are called nodes. If you want the nodes to interact and coordinate efforts in constantly maintaining and updating a blockchain's current state, we have to create an economic incentive. This incentive must have an intrinsic value in the eyes of all those who participate in the work of the blockchain. Something that is not attractive cannot incentivize people. The economic incentive used in a blockchain as compensation of a community's efforts serves also as a means of payment for the use of the network's services by outside clients. Such measure of value and the means of payment in a blockchain is called cryptocurrency of this blockchain and its network. Each blockchain and the network where this blockchain is deployed has its own cryptocurrency. The first public blockchain and its network, known as Bitcoin, has its own cryptocurrency with the same name, Bitcoin. In order to differentiate blockchain and currency, the former is written with capitalized B. The cryptocurrency Bitcoin is traded on countless exchanges by the symbol BTC. The public blockchain and its network, known as Ethereum, has its own cryptocurrency called Ether, symbol ETH. The public blockchain and its network, known as Avalanche, has its own cryptocurrency called AVAX, symbol AVAX, etc. Okay, now we know that a public blockchain is an open, decentralized database which stores records of various objects and their relocations, called transactions. What objects are we talking about? The major object transacted in a blockchain is its own measure of intrinsic value, that is the cryptocurrency. Block 3. Owners of cryptoassets. Cryptocurrency is transacted in a blockchain between its owners. Owners could be anyone or anything. Owners could be computer programs which complete various activities. Computer programs performing contractual operations in a blockchain are called smart contracts. Smart contracts, together with humans and groups of humans, can be owners of cryptocurrencies and other crypto assets. One of the most important features of a public decentralized blockchain is its ability to preserve ownership without storing the real names of owners. The ownership in crypto networks and blockchains is represented by a conditional code known as address. Addresses consist of letters and digits and look similar to this. Such addresses are the only real owners of cryptocurrencies or other crypto assets in a public blockchain. When we talk about transactions, we talk about relocation of assets from one address to another. No real names or other sensitive information can be found in a blockchain. Since real names are not stored or present in any way in a blockchain, a practical question arises. Can someone track down the real owner of a blockchain's address? The answer is obviously yes, if the owner of an address is a smart contract, because this information is purposely made public by programmers who create smart contracts and want people to have trust in their program and interact with it. If the owner of an address is a private individual or a group of people, proving their ownership becomes problematic. Sometimes it is completely impossible, sometimes laborious and time-consuming analysis allows investigators to establish a link between an address and a real-life person. Since the direct link between an address and its real owner is not present in most public blockchains, these blockchains are called pseudonymous. The letters and digits in an address form the pseudonym of the owner. It is worth noting that there are plenty of public blockchains that are not pseudonymous but completely anonymous. There is nothing one can extract from an anonymous blockchain. Transactions here obscure not only the addresses involved with relocation of crypto assets, but the amounts of assets being transferred from one unknown subject to another. This tricky situation with blockchain addresses raises another practical question. If all crypto addresses are, in best case, pseudonymous, let alone fully anonymous, how can a real owner prove that the assets ascribed to a blockchain's address in reality belong to him, or not to somebody else? Obviously, I cannot transact with my assets, transfer them to someone, or accept payments from others without substantiating of my ownership claims. The ownership evidence in crypto economy is called private key, and it looks very similar to any blockchain address. The private key to an address is the most important thing in the entire crypto economy. The one who controls the private key controls all assets stored in that corresponding address. If you lose your key, you lose all your crypto assets. The software running blockchain takes one private key and mathematically generates from it another key called the public key. Then from the public key our blockchain address is derived, also mathematically. The mathematics that rules crypto key generation has one magical feature. It works in one direction only. From a private key, one can derive a related public key. From that public key, an address can be derived, but not vice versa. If we know the address, there is no way on earth that we can derive from it its underlying public key. If we know the public key, it will never divulge its private key. This unique one-wayness of cryptology ensures that our cryptoassets always remain secure, at least until the moment when we ourselves share our private keys with somebody else, by mistake or negligence. Or some bad guys steal it with a Trojan or a keylogger. The next important question is the storage of our private keys. Block 4. Crypto wallets. Actually, there are only two ways to keep our keys in a secure place. One is a special software program installed on our computer or mobile device. Such programs are called hot wallets or software wallets. An alternative option is storing the keys in an encrypted microchip, usually installed into a standalone gadget, a kind of a USB stick or a USB dongle. These are known as cold wallets or hardware wallets. Taking into account literally limitless risks unexperienced crypto users are exposed to on their computers, I highly recommend not to store your private keys in a software wallet and instead always use any type of a cold hardware wallet. There are plenty of them, but there are three most functional and popular hardware wallets on the market which are suitable for use in DeFi. One is Trezor T. Another one is Ledger Nano X and SafePal S1. It's up to you to decide which one you like the most. YouTube is packed with video guides explaining the pros and cons of all hardware wallets with step-by-step instructions on their setup. I personally use all three of them for different purposes and situations. For instance, Trezor T is the most comfortable hardware wallet to work with on a desktop computer or laptop. Ledger X is the most versatile because it supports the biggest number of blockchains and networks. At the same time, its screen is tiny and its mode of operation is considerably slower and less comfortable than Trezor's T. And finally, SafePal is the best choice for those who prefer the DeFi from their mobile device, smartphone, or tablet. Now we know that crypto assets belong to crypto addresses and are stored in a decentralized database called blockchain. The only way to establish ownership on these assets is to present the private key, which is mathematically and cryptologically related to the corresponding address. All crypto assets change owners and relocate from one address to another. These relocations are called transactions, and these transactions are also stored in the blockchain. Let us introduce a few more concepts which will add more clarity. You've definitely heard these terms before, but now I will show you their place in the whole picture. Before being stored in the blockchain, transactions are put together in groups called blocks. That's where the term blockchain comes from, chain of blocks. Computers which check the validity of transactions, join them into blocks, and finally add blocks to the blockchain are called either miners in Bitcoin and blockchains which derived from it, or validators in the majority of modern blockchains like Avalanche, Phantom Opera, Polkadot, Cardano, Tezos, Tron, BNB Chain, Harmony, Neo, Elrond, and hundreds of others. Crypto assets are relocated from one address to another. Wonderful. But what are these crypto assets in reality? Block 5. Crypto tokens. Well, there are two major types of crypto assets, one of which we have already discussed, cryptocurrencies. Cryptocurrencies are a measure of value universally accepted by the entire blockchain and the network in which this blockchain has deployed. In other words, cryptocurrency is the central nerve of a blockchain. It is a vehicle which gives it a financial incentive to operate. We have already learned the names of several cryptocurrencies. Bitcoin, symbol BTC, powers the operation of the same name network and blockchain. Ether, symbol ETH, powers the operation of the network and blockchain called Ethereum. AVAX, symbol AVAX, powers the operation of the network and blockchain called Avalanche. These are all cryptocurrencies, the first type of cryptoassets. The second type is called crypto tokens. Crypto token is also a measure of value, but rather of an individual project which lives in a crypto network. For perception convenience, we can think of a crypto token as a share of a company in the world of TradFi. In the majority of cases, every new crypto project today has its own token, which fulfills various application missions. A token can be used for the decentralized governance and voting. It can be used for the receipt of financial services. It can be used as a pass to a large variety of information services. It can be used for file storage, for relocation of crypto assets from one network to another, and so on and so forth. Now I will name some key groups of crypto assets which we will be working with in DeFi on a regular basis. Stablecoins are tokens whose exchange rate tries to follow as closely as possible the market value of $1. It is said that the price of a stablecoin is pegged to that of a USD. A stablecoin tries to avoid market volatility. It tries to remain stable. Utility tokens serve as a means of payment for various services of a crypto project. For instance, we pay with a utility token and in exchange gain access to some precious analytical information, or we acquire access to computing power or storage or additional rewards for investment, etc. Governance tokens are used for running a DAO, Decentralized Autonomous Organization, which is the most popular structure in DeFi for collaboration on projects. Governance tokens facilitate management, distribution of responsibilities, and voting in a DAO. NFTs, non-fungible tokens, are probably the most hyped type of cryptoassets today. NFT is a certificate which proves the ownership rights of a unique digital asset. The word fungible may create mental confusion here, so I dwell on the theme briefly. A $1 bill in my pocket has no difference from another $1 bill in your pocket. That's because banknotes, as well as metal coins, are fungible assets. They are easily interchangeable. All cryptocurrencies, by the way, are fungible assets too. Bitcoin, Ether, AVAX, etc. Each NFT is non-fungible because it's unique. You cannot substitute one NFT with another. It will be just a different NFT with different individual characteristics and value. As I said, each NFT is tightly bound to a unique digital object. This object could be a digital photograph, a digital painting, a musical composition, or a digital certificate proving the ownership of a real-life property like a house, car, yacht, palace, even an island. All these unique digital certificates of ownership rights are NFTs. Many serious analysts strongly believe that NFT will soon become the key instrument for digitalization and tokenization of all types of property in real life. Now, before we move forward, let's reinforce the basics we have already learned and recite the verse about the crypto house that Jack built. Crypto assets are stored in the blockchain and are attached to crypto addresses. The ownership rights to an address is granted by the private key mathematically and cryptologically connected to this address. Private keys are stored in software or hardware wallets. There are two major types of crypto assets: cryptocurrencies and crypto tokens. Crypto assets change owners and relocated from one address to another. Such relocations are called transactions. Transactions are put together in blocks by miners or validators and then stored eternally in a blockchain. Once a block is added to the blockchain, there is nothing one can change in the records retroactively. All blockchain data is irreversible and final. Now, let's take one more step forward. We have already discussed how crypto assets change hands constantly and that transactions are fixed permanently in the blockchain. The question is, where should we go for this exchange to happen? Block 6. Crypto exchanges. One place is already known to everyone: centralized crypto exchanges, CEXs for short. The biggest and most popular CEXs are Binance, FTX, Coinbase, Huobi, and KuCoin. These are the top 5 from the list based on the daily volume of transactions. In reality, there are hundreds and even thousands of centralized crypto exchanges operating in the world today. Until recently, someone who wanted to exchange one crypto asset for another, had no alternative but to use sexes. And that was a very sad and tragic situation. We all remember the golden rule of crypto. Not your private keys, not your assets. And you know what? None of the centralized crypto exchanges give you access to any private keys. All the keys and all the assets there belong exclusively to the exchanges themselves. Centralized crypto exchanges are similar to traditional banks, which store our money in their vaults, ostensibly for our convenience. Centralized exchanges possess the private keys, which control the addresses your assets are assigned to. Therefore, theoretically, they can do to your assets whatever they want. They can freeze them, block them, they can ask for verification of your assets' provenience at any moment, and they can confiscate them. This can happen, for instance, on the orders of your government, or the government of that exchange's jurisdiction, or because of political sanctions. The natural conclusion suggests itself. Trust your crypto assets only to your own hardware wallets and try to avoid centralized crypto exchanges whenever possible. Good thing is that DeFi has its own space for swapping crypto assets, so-called decentralized exchanges, DEXs. And these DEXs just don't interact with the accounts opened on centralized exchanges at all. DEXs work only with personal wallets, which we control exclusively with our private keys. And don't worry, today the volume of transactions in decentralized exchanges, DEXs, already exceeds the volume of centralized ones, and this gap is just getting larger and larger. This happens because of the advantages of DEXs over SEXs, such as a full inclusiveness of exchange operations. Inclusiveness means the complete lack of any licenses or permissions for our actions, let alone the fact that a decentralized exchange cannot technically impose humiliating checks on our assets, freeze them, or control in any other way. The advantages of DeFi, though, are much larger than inclusive exchange transactions. As I have already mentioned, DeFi allows us to engage in operations that are impossible both in traditional finance and on centralized crypto exchanges. Operations such as direct lending and borrowing, market making on exchanges, selling insurance policies to others, creating our own assets and crypto derivatives, running personal hedge funds, acting as portfolio managers, etc. By the way, all this magic is also completely inclusive and does not require permission from anybody. Well, I think now we have a sufficient understanding of crypto basics and are ready for the delights of decentralized finance itself. Part 2. Basics of DeFi. Block 7. Genesis of DeFi. DeFi became possible only after blockchains learned to do something more complex than just relocating cryptocurrencies from one address to another. Believe it or not, but until 2015, neither Bitcoin nor any other blockchains knew anything else but how to play ping-pong with crypto assets. Buying and selling, exchanging, speculating on price. That was it. No wonder that during the first 6 years of social adoption of crypto economy, activity was largely limited to wild speculation on centralized crypto exchanges. Taking advantage of their monopoly, these sexes periodically expropriated crypto assets from their clients. Sometimes the exchanges were exploited by hackers. Sometimes even the owners and managers of sexes themselves stole. The hope of doing something more meaningful than buying low and selling, trying to sell high, appeared only after the birth of a blockchain capable of working with complex smart contracts. We already know that smart contracts are computer programs which are designed to carry out contractual actions. In a simplified way, we can visualize a smart contract as an interaction between three objects: parties to the contract that confirm their authority with their digital signatures, subject of the contract which one party gives access to and another party receives upon fulfillment of certain conditions, and conditions which trigger the execution of the contract. If we want these objects to start operating, we need an appropriate environment. Such an environment consists of a crypto network whose nodes know how to do the necessary math for running complex contracts. By and large, the transfer of crypto assets from one address to another, something Bitcoin knows how to do, is also the resulting work of a smart contract. This smart contract is very simplistic, but it's still a smart contract. If we want to run fully fledged financial operations like lending, borrowing, pledging, insuring, distributing rewards based on time and size of investment, all these actions require smart contracts of a much higher degree of complexity. But what is clearly the most important thing to have at hand is the network capable of running calculations for these complex smart contracts. Such a network should resemble a decentralized computer, since its calculating power is spread over its servers located all over the world. In 2015, the world finally saw this decentralized supercomputer crypto network, capable of running the calculations required for complex smart contracts. It was designed by a Canadian-Russian Vitalik Buterin and implemented by a group of coders and entrepreneurs. This network was named Ethereum. Ethereum was launched in July 2015 and has since then become the principal platform for the development of DeFi. Today, Ethereum has numerous competitors, crypto networks capable of running complex smart contracts with their own blockchains, currencies, and tokens, but Ethereum continues to attract 65% of all funds brought to DeFi. I must say that at least at the beginning of your DeFi journey, it is highly unlikely that you will want to work with projects deployed on Ethereum. The reason is purely practical: fees. That is, the cost of Ethereum servers' computing power when running smart contracts. These fees are insanely high. Even when the computational load of the Ethereum network stays reasonable, the cost of processing a regular smart contract will vary from 10 to 50 USD. The peak loads make the fees reach 150 USD, sometimes $200, depending on the complexity of the smart contract. Expensive fees are not the only problem of Ethereum. Vitalik Buterin's network is based on Bitcoin's architecture, which is extremely secure but also unfortunately extremely slow. Today it takes between 14 and 20 seconds to complete a transaction in Ethereum. This speed may appear like great progress in comparison to Bitcoin, which can handle 7 transactions per second and adds a new block to the blockchain once every 10 minutes. However, the majority of modern blockchains of the 4th and already 5th generation know how to add new blocks once every 2-4 seconds, while some are even capable of doing it in a fraction of a second. Block 8 Crypto Networks for DeFi. Let's look at the list of major crypto networks apart from Ethereum, where the most promising and popular DeFi projects are deployed today. Avalanche, Avax, Phantom Opera, FTM, BNB Chain, BNB, Polygon, Matic, Solana, Sol. The names of the networks are followed in parentheses by the symbols of the cryptocurrencies which preside in the respective blockchains. You should memorize these names, because the fees in each network are paid only with its native cryptocurrency. This knowledge helps us to understand the first step we should make in order to interact with DeFi projects in the new network. We need to send a small amount of the native cryptocurrency to our address in that particular network, otherwise we won't be able to run a single transaction. There are more than 100 names in the complete list of crypto networks where DeFi projects are deployed today. With time and experience, you will learn how to work with the majority of them, but I strongly recommend to start with Avalanche, Phantom, BNB Chain, Polygon, and Solana, because in my view, they have the best balance of the quality of DeFi, the speed of execution of smart contracts, and the size of fees. All these 5 networks have an average transaction speed of 4 to 7 seconds. The fee at rated load stays under $1, and at peak load doesn't exceed to $3. Now let's have a look at the major types of financial activities we can get involved in DeFi. Block 9 Types of DeFi. I think for the purposes of our video course, the most productive way to describe the different types of DeFi activities would be through the lens of profit, not through technologies involved. Simply put, I suggest to first answer the question, what are the ways to make money in DeFi? Imagine the situation. You surf the net and come across a new DeFi project advertised heavily by some influencer on YouTube and Twitter. And that project promises a fantastic yield of 2,000 annual % rate, APR for short. Of course, it sounds great, but trust me, it's vital to understand where this yield comes from before you bet your money on this. Because if the yield in such project comes from the thin air, you have an equal chance of losing your initial investment instead of gaining the 2,000 APR profit. This is why it's important to rely entirely on your understanding of the mechanisms underlying profits in DeFi, instead of listening to the tips and recommendations which influencers and experts rather selfishly leak. The concluding part of our DeFi primer will be dedicated to this very purpose, laying the groundwork for a proper understanding of the mechanisms underlying various types of profit in DeFi. In order to properly assess the types of yield available in DeFi, let's have a look at the following mind map, which I have been building over a span of 3 years. As you can see, DeFi has already grown to an impressive world of various projects which are based on the principle of money Lego. The bricks of this construction toy are represented by financial primitives such as transaction fee, rewards, monetary leverage, loans, collaterals, etc. Let us now try to classify the major trends in DeFi shown on our mind map based on the financial primitives these trends use for profit generation. Yield farming, YF for short, is a type of profit generated by those participants who provide their assets to the exchange operations of other users. Yield farming is mostly practiced at decentralized exchanges, DEXs. Yield farming optimization, YF optimization, allows users to increase their profits with the help of various strategies ranging from automatic reinvestment of profit, so-called compounding of interest, to investing in the third-party projects. Capital markets allow investors to lend their assets to other market participants, it's called lending, as well as to take out loans themselves using their open yield farming positions as collateral. These loans allow investors to create a leverage in the initial yield farming position. It's called leveraged yield farming, LYF for short. Leverage is a situation where your loan exceeds the size of your own funds. Delta-neutral and pseudo-delta-neutral markets allow users to turn their highly volatile assets, these are tokens whose price fluctuates up and down excessively, in a close analog of stablecoins. These are tokens whose price is pegged to the US dollar, and use them afterwards for yield farming. Derivatives, such as perpetual futures and options, are special assets which give right or confer obligation to purchase in the future other financial assets at a predetermined price. There are two cases for using derivatives in traditional finance: reckless speculation and, paradoxically, prudent insurance of our main assets against the risk of price crashing, so-called hedging. In DeFi, we can also use derivatives for both purposes. The use of non-fungible tokens, NFTs, and the products of gamified DeFi, GameFi for short, allow to combine yield farming with investing in the rapidly developing creative markets, from digital photography, painting, and music to mass tokenization of real estate and colonization of metaverses. There are many crypto asset funds controlled by decentralized autonomous organizations, DAOs. These funds are called protocol-owned liquidity, POL. Let me remind you that in DeFi, DAOs are the most popular structure for joint management of projects. Investing in such funds equals, metaphorically speaking, delegation of financial decisions to the collective mind. Another kind of crypto asset funds are used by on-chain services, which are deployed directly in crypto networks and their blockchains. Those who provide liquidity to such funds are lavishly rewarded because without their liquidity, such on-chain services simply cannot operate. The most popular on-chain DeFi services are following: insurance of various DeFi investment assets and risks associated with the computer code of smart contracts and decentralized applications, dApps. Bridges, which facilitate the transfer of crypto assets, cryptocurrencies and tokens from one network and blockchain to another. Launchpads, which organize initial token offerings of new prospective projects. Structured products are various investment strategies wrapped in a single ready-to-use financial asset, etc. The mind map you're seeing on your screen has been drawn since the first days of the DeFi revolution, but in no way it is close to a complete representation of the whole variety of trends which pop up in decentralized finance almost daily. Unfortunately, there is no space in our primer for a detailed examination of all these trends and projects. That's why I have decided to concentrate on several key types of profits which are simple enough for you to start with in your practical journey through DeFi. Block 10. Liquidity providers and pools of liquidity. Decentralized exchanges are places where any interested person can swap cryptoassets. In order to swap one token for another, there should be a stock of both tokens somewhere. Who creates such stocks? In DeFi, these are the users themselves. Anyone can come to a decentralized exchange and provide their tokens for other market participants to swap. Once you do that, you become a liquidity provider, LP. All swaps in DEXs are done in pairs of tokens. For instance, AVAX USDC or FTM MIM. What does it mean? AVAX and FTM are, as you already know, cryptocurrencies of the blockchains, Avalanche and Phantom Opera, respectively. USDC and MIM are popular stablecoins pegged to $1. The DEX pair AVAX USDC is the place where anyone can come and exchange their cryptocurrency AVAX on stablecoin USDC, or vice versa. The DEX pair FTM MIM is the place where swaps are done between cryptocurrency FTM and stablecoin MIM in either direction. The places where various pairs of crypto assets are mutually exchanged are called liquidity pools. In DeFi, liquidity providers, that is, those who bring their assets to liquidity pools, are lavishly rewarded by DEXs for their contribution. Part 3. Strategies and Technologies of DeFi. Block 11. First DeFi revolution, yield farming. There are two types of rewards for liquidity providers. A share of the transaction fee, which DEXs charge for each exchange operation, and additional rewards, which DEXs use as an attraction bonus, trying to bring in as many users as possible. Why do DEXs need these users? That's simple. The more people come to a DEX and exchange their tokens, the higher the transaction fee will be, and the higher the revenues of liquidity providers will be in the future. This very idea of paying extra to LPs, in addition to a share of the transaction fee, has been coined as yield farming. The crypto lending platform called Compound was the first to use it on June 15, 2020, and that day is commonly reckoned as the birth of the DeFi revolution. Decentralized finance as a separate trend in the crypto industry appeared 2 years before that date, but only additional rewards paid to LPs by Compound allowed to attract 1,000 times more capital to DeFi in a very short time. Now, additional rewards are paid to liquidity providers, mostly with the tokens of the DEXs themselves. That's natural, because where else can they get value for those extra bonuses? That's why these types of DEX tokens are called reward tokens. Some uneasy suspicions give birth to the question, where do these reward tokens come from? Well, the suspicions didn't let you down. The reward tokens come from thin air. They're simply minted automatically by a smart contract with each new block added to the blockchain. As we know, modern crypto networks are fast. It means a new supply of tokens floods the market every 2-5 seconds. In the majority of cases, the reward tokens have no intrinsic value. That's why their market price sooner or later goes to zero. That's why the most reasonable thing to do is to exchange these DEX tokens to something more valuable as soon as we receive our yield farming rewards. What is more valuable? Well, that could be stablecoins or the cryptocurrencies of reputable blockchains. Something like ETH, FTM, Sol, Matic, AVAX, etc. Today, the majority of DEXs try their best to raise attraction to their reward tokens in the eyes of the users. Some DEXs limit the total supply of their reward tokens with a reasonable number. Others regularly burn, that means liquidate, the already existing supply. The most creative DEXs create special conditions for additional revenue for those users who agree not to sell their reward tokens immediately upon receipt, but instead are willing to lock them for an extended period of time in a special container called Vault. This locking not only dramatically reduces the sale pressure on the reward token, but also turns this mostly useless token into a yield-bearing asset, because the owners of tokens locked in vaults are either promised a share of all profits generated by the DEX, or receive a revenue boost to other investments they have in the respective project. As you can see, it's not easy to assess the real value of the reward tokens with the added functionality of extra yield generation. At least one must know how to analyze the real cash flows of the project and to compare those data against the speed of inflation. I have no doubts that one day you will definitely learn how to perform such analysis and efficiently invest in yield-bearing crypto assets. In the meantime, I am pretty positive that following a simple rule will save you a lot of unnecessary trouble and disappointment in the beginning of your DeFi journey. The rule of thumb reads like this: get rid of all reward tokens as soon as you can, preferably right upon receipt. Now we can move forward. Block 12. Yield farming optimization. The use of platforms for yield farming optimization gives us another two types of revenue. The first is compounding, which is pretty obvious. The optimizer regularly collects all transaction fee and extra rewards due to us, exchanges them for the two tokens we initially deposited in our liquidity pool, and then automatically reinvests those tokens into the same pool. This action increases our investment capital and creates the so-called compounded interest. One can argue that we can exactly do the same on our own without optimizers, but there is a trick. The more often the compounding is done, the more efficient it becomes. The optimizer can afford doing reinvestments very frequently, sometimes once every minute. It can do it because it spreads the network commissions among all the investors in the optimization pool. If we try to reinvest our rewards ourselves with the same high frequency, the commissions might eat up all of our revenues. Similar to DEXs, yield farming optimizers also give their users another type of revenue, that is extra rewards paid with the token of the optimizer itself. Since the compounding of interest offered by optimizers gives users more revenue than transaction fee at DEXs, optimizers can afford the luxury of not using their token for rewards so aggressively. As a result, the total supply of their tokens is almost always hard-capped, limited in number, and these tokens are almost always convertible into yield-bearing assets. One more distinction deserves our attention. The terms for profit sharing with optimizers are usually much easier than with DEXs. Sometimes it is enough to stake the optimizer's tokens into a simple vault without time locking in order to benefit from revenues generated by this optimizer. Block 13. Capital market. The most attractive type of revenue is waiting for us in the capital markets. Here we can expect high-quality yield for lending, that is, depositing our money in a joint pool of assets which other market participants use for taking out their loans. In traditional finance, this revenue stream is fully out of reach of common people since it constitutes an exclusive privilege of bankers. Lending, though, is far from being the sole source of income in DeFi capital markets. There are numerous platforms which allow users to take zero-interest loans or even yield-bearing loans. Can you imagine a situation where a traditional bank regularly pays you interest after you have borrowed money from it? In the meantime, the last generation of capital markets in DeFi turned yield-bearing loans into a common practice. The tour de force of modern capital markets in DeFi is the ability to offer leveraged loans which raise the efficiency of invested capital to the highest level. The leveraged loan position is constructed in 3 steps. Step 1. I deposit some of my crypto assets in a lending pool. Step 2. I use this deposit as collateral, against which the DeFi protocol mints a certain amount of its own stablecoins and gives them to me as a loan. Step 3. I exchange the received stablecoins into the tokens I used for initial deposit in the lending pool, and then add them to the same lending pool, thus creating a leverage. Under certain conditions, these steps can be repeated 10 or even more times, which will culminate in a position with an incredibly high yield. However, it should be taken into account that each new round of the leveraged loan exacerbates not only our profits, but the risks too. The last type of revenue in the capital markets involves investing into the so-called liquidation pool. This pool is used when the collateral of a borrower doesn't have enough funds to cover the minimum required for the loan. This situation can happen, for instance, when a highly volatile crypto asset was used for collateral and then suddenly its price crashed down in the market. In such a scenario, the lending platform forcefully liquidates the under-collateralized debt position, the collateral is sold in the open market, and the proceeds are shared among the liquidation pool's investors. Obviously, the investing in a liquidation pool doesn't come without its own share of risk. In case of the collateral, under liquidation has developed to the extent that it no longer covers the loan, the missing funds are taken from the liquidation pool, thus picking the pockets of those who invested into it. The list of different types of revenue in DeFi can go on, but I assume the topics we have already covered are more than enough for an efficient start. In the future, we plan to release regular updates to our Alphaleaks DeFi Primer, in which we will try to cover as many knowledge gaps as possible. However, my teaching experience suggests that the best way to start practicing in DeFi is by using some basic investment platforms which one fully understands. In my opinion, such platforms are reputable yield farming optimizers and lending protocols. The next step could become the use of more sophisticated types of revenue in capital markets, followed by investing in the DeFi insurance funds, derivative markets, and finally, the construction of delta-neutral and pseudo-delta-neutral investment positions. Part 4. Choosing projects for investing. Block 14. The valuation logic in DeFi. Now that we know what types of revenue we can find in DeFi, it is important to learn how to evaluate projects in terms of their attractiveness for investing. Contrary to a widespread misconception, using tips and recommendations of experts, successful traders, and popular influencers can become lethal to your financial well-being. Not because people are lying and routinely pursuing their own interests, but because one man's meat is another man's poison. Each one of us has a unique measure of risk tolerance, unique sense of greed, unique ability to face temporary losses, etc. The best advisor in our choosing projects for investing is our own knowledge supported by common sense. Knowledge is Captain Obvious, but what about common sense? Believe it or not, but its role in the quest for good DeFi projects could not be overemphasized. Let me demonstrate this to you by using a simple example. Let's say we find a great decentralized exchange optimizer which promises an eye-popping return of 5,000 APR, annual percent rate, in one of its liquidity pools. Question: how real is this yield? Well, we already know that the only type of revenue in decentralized exchanges is a share of swap fee plus extra rewards paid from the new supply of the local reward token. Respectively, the only meaning the phrase yield equals 5,000 APR has is the promise to mint as many reward tokens that it would equal 5,000% of what we have invested initially in the liquidity pool. Do you think the exchange will keep its promise and mint that number of tokens? Why not? They can print as much as they want because they print their tokens out of thin air. Now, let's look at the behavior of the majority of liquidity providers for this pool, especially since we're planning to join their ranks. Every time liquidity providers get their rewards paid in reward tokens, they immediately get rid of them by exchanging them into stablecoins or cryptocurrencies of major blockchains. Why? Because we all know that the reward tokens have no intrinsic value. What do you think will happen to the price of the reward token if it stays under the strong selling pressure 24 hours a day? You're right, the price will be constantly crashing. 5,000 annual percent rate equals 13% per day. That's how many reward tokens you will get daily. At the same time, the price of the reward token will lower daily 20, 30, 40, 50%. Sometimes the price of the reward token stops crashing and goes up. This happens not because the token magically acquires intrinsic value, but because a new group of uninformed users flooded this DeFi project. They have come because they were allured by this eye-popping APR of 5,000%. The more new users come, the higher the price of reward token flies. One thing is for sure, the price of reward tokens eventually gets annihilated under any scenario. In the 4 years that I have spent in DeFi, I have never seen pure reward tokens which haven't developed completely. That's one example where our basic knowledge coupled with common sense helped us to draw an important conclusion. The figure of 5,000 APR has nothing to do with real yield. In the best case scenario, after 1 month of providing liquidity to such a pool, we will keep our initial investment intact. Otherwise, we risk to lose a good portion of it. Now, we will try to appeal once again to common sense and search for a positive solution using our previous example. Question: if the situation with 5,000 APR is so hopeless, is there any reason to come even close to liquidity pools promising extra high yields? Let's consider two different cases. Case number one. We provide liquidity to a pool which consists of a pair of two tokens. One is a cryptocurrency, another is a stablecoin. For example, AVAX USDT, or FTM USDC, or BNB BUSD, etc. This pool is announcing yield of 5,000 APR. And case number two, we invest in a pool with the same yield APR, but the liquidity pair consists of a stablecoin and the native reward token of the DEX where the pool is deployed. Question: do you see any difference between these two cases? Please put this video on hold and try to answer the question by yourself. Then compare your explanations with the version of reality I'm going to give you in a moment. In case number one, we invest our money in relatively good crypto assets and get rewarded with a token which devalues constantly. In this scenario, after 1 month, we will keep our initial investment intact because it's composed of a pair of good tokens. Additionally, we'll have reward tokens which will generate a yield somewhere between 10 to 30% depending on the speed of the reward token's price devaluation. You don't have to be a genius to realize that such investment is a godsend, since nowhere in TradFi we can get such a high yield. In case number two, we have put our money in a pool, one half of which is made of the same reward token which develops with the speed of light. After 1 month, we will have the same rewards of between 10 to 30% of our initial investment, but the initial investment itself will devalue so terribly that there are high chances that the summary loss will outweigh the revenue from the rewards. The question, which one of these two cases do you like more, is another Captain Obvious, but in real life there is a slight problem. There is no way that you will find a promise of 5,000% APR for a liquidity pool consisting of two good tokens in DeFi. This reality, though, gives another advantage to conclusions based on common sense. A liquidity pool consisting of two good tokens and promising yield of 30 APR in any circumstances is much better than a pool promising yield of 5,000 APR, but consisting of a pair which includes the reward token itself. Let us now look at another example taken from a different DeFi field. Let's say we find a capital market project which promises 50% APR for investing our stablecoins into the lending pool. Our knowledge acquired so far suggests that it's a good deal. How else could it be, since our initial investment stays pegged to the US dollar? 50% APR for our greenback must be a real dream, since in comparison we can hardly get 2% in our local bank. Now, it's time for common sense to come into play. You just look around and see that lending stablecoins at the overwhelming majority of rival capital market projects never brings us more than 2 to 10% APR. And here, somehow, we have an exclusive offer of 50% APR on our stablecoins. Does this situation raise a red flag for you? If it does, I'm happy, since our Alphaleaks course starts to bear fruit. Whenever you see such exclusive deals in DeFi, please run away as fast as you can, because those who make this kind of offers already have a plan how to make you lose your initial investment. I think now is the best time for drawing the final line on our primer with the discussion of risks in DeFi. Block 15. Risks in DeFi. In the world of finance, both traditional and decentralized, there is one global and irrefutable truth. Yield is a derivative of risk. Every yield depends directly on the risks involved. The higher the yield, the higher the risks. The lower the yield, the lower the risks. If we see one project promising 10% APR and another one promising 200% APR, we must have no doubts that the risks involved in the second project are roughly 20 times higher than the risks of the first one. There are numerous risks in DeFi, and before we learn how to cope with them, let's have a closer look at the most dangerous enemies lurking in wait out there in the decentralized jungle. Smart contract risks. Smart contracts control everything in DeFi. When you interact with a project, you trust your money not only with a certain group of people who run this project, but also with the computer code underlying smart contracts this project uses. Even if the owners are honest in their wish to share profits with users, if something goes wrong with the smart contract or a hacker breaks its code, the users have all the chances to lose their money. If your portfolio holds mostly volatile crypto assets instead of stablecoins, as it should do, even if these assets are of the highest quality, like cryptocurrencies of major blockchains, a massive market meltdown can harm your portfolio in a very painful manner. Sometimes you can lose 90% or even more. The greatest danger which we expose ourselves to while providing liquidity to DEX pools is called impermanent loss. The best way to demonstrate the risk of impermanent loss is by using a real-life example from my personal DeFi practice. In April 2022, I provided liquidity to a pool which consisted of 6 different cryptocurrencies of major blockchains: FTM, AVAX, Sol, Matic, BNB, and Luna. All 6 assets could easily be considered blue chips of the crypto world, since they represented the most popular platforms for running smart contracts: Phantom Opera, Avalanche, Solana, Polygon, BNB Chain, and Terra. The yield in this pool was excellent, 29% APR. Then, in the middle of May, something happened that was almost impossible to foresee. The entire ecosystem of the Terra network lost equilibrium and collapsed. Terra was home to its own stablecoin, named UST, which was algorithmically pegged to the US dollar with the help of the utility token Luna. In one moment, UST lost its pegging to the dollar. Smart contracts of Terra tried to stabilize the exchange rate of UST with additional minting of Luna, which in turn caused the price of Luna to collapse. In the span of several hours, both UST and Luna literally became worthless. In this cataclysm, by the way, investors lost almost $60 billion. Now, you remember that my liquidity pool had 6 different assets, and it would be reasonable to suggest that the annihilation of one asset out of 6 couldn't do much harm to the rest of the investment. Without going into technicalities of the ways impermanent loss works, I will only say that the math underlying liquidity pools follows a strict pattern. The higher the price of a token in the pool, the smaller the number of the token, and vice versa. The lower the price of a token in the pool, the bigger the number of this token. This rule is exactly what creates the risk of impermanent loss. The complete devaluation of the Luna token almost entirely wiped out from my liquidity pool all tokens but Luna. FTM, AVAX, Sol, Matic, BNB were all gone. And what was left was Luna, and it was worthless. Impermanent loss efficiently turned my expected 29% APR profit into 99% loss of all initial invested capital. Subjective risks result from our inability to control emotions and manage our portfolio properly. The worst enemy here is greed. Let's assume we create a leveraged loan position using a stablecoin as collateral, and we run the revolving credit not 2 or 3 times but 12. The motivation is understandable. A position with such big leverage promises almost 200% APR, and that is on stablecoin, which is presumably pegged to the dollar. Risks seem low, yield seems gorgeous. Then something strange happens. The stablecoin we use as collateral depegs slightly because of some technical fluctuations of the market. The depeg is minuscule, only 2%, but the huge leverage we created so recklessly inflates the depeg to 24%, which automatically subjects our position to a forced liquidation. Result, instead of 200% APR profit, we lose a big chunk of our collateral. Why did this happen? Because we ignored subjective risks and allowed our greed to outweigh caution. Natural DeFi risks. DeFi gives us a unique chance to decentralize everything: our profit, our losses, our almost limitless rights, and our just as limitless responsibilities. In DeFi, we're our own bank. We are the only ones who control the situation, including the security of our transactions and the storage of our assets. The bankers don't nibble at our profits, but they don't care about our security either. A malicious attack on our computer with a Trojan or a keylogger might give an intruder full access to our crypto wallet. For a professional hacker, it takes roughly 2-3 minutes to transfer all crypto assets from our addresses elsewhere. The use of hardware wallets gives us slight relief, but doesn't guarantee complete invulnerability. A thief can break into our house and steal our beloved Ledger Nano or Trezor T wallet. That's why it's important to always use protection codes with our hardware wallets. But even in this case, we cannot exclude the use of brute force. With all that said, whether we like it or not, we must face the harsh and exciting reality. Once in the world of crypto, we are on our own. That means that from now on, our major concern is to ensure maximum protection against theft, deception, and even direct violence. As you can see, the risks are high and diverse in DeFi and crypto. You probably wonder if there is even a single chance to cope with them. If we Google it, we find a plethora of recommendations to scrupulously analyze smart contracts in an attempt to detect potential vulnerabilities and malign code. My sincere advice, don't lose your precious time on this illusionary practice. No way on earth you will succeed in discovering holes and hidden defects in computer code written by professionals. There are literally dozens of great decentralized applications which fell prey to hackers after being audited by the best auditing firms. Another advice, don't even think of predicting market movements and price changes. There are thousands of very sophisticated tools of technical and fundamental analysis used both in TradFi and DeFi. Believe it or not, I have spent 28 years studying and practicing on the stock exchanges all over the world, using a multitude of tools from esoteric Elliott wave analysis to the theory of chaos, spectral analysis, and neural networks. And you know what? Nothing works. Nothing is certain. Nothing predicts the future. I bet after hearing all that scary stuff, you decide that crypto is taboo, right? Of course wrong. It is wrong because it's really silly to say no to the best financial opportunity which comes once in a lifetime, the opportunity of decentralized finance. It is also wrong because I know a magic formula which can override all financial risks of DeFi in one fell swoop. And the best thing is that I am going to share this formula with you right away. The magic formula of success, which can save you from devastating losses in DeFi, consists of two simple rules: rule of pyramid detection and rule of money management. Block 16, rule of pyramid detection. There is a popular misconception which defines a pyramid of Ponzi, or as it's called otherwise financial pyramid, as a scheme which secures the revenue of those who came first from the money of those who came later. This definition is a naive view that outsiders have of financial markets. Why? Because the definition given above describes absolutely any financial investment. Every imaginable investment of capital implies first buying low and selling higher later. I bought shares of Apple and paid $100 each. Then I sold my shares in a couple of years at $1,000 each. Dare I ask, who was the buyer of my shares? Exactly, a new market participant. Who secured my revenue of $900? The one who came later. According to the common definition of Ponzi pyramid, the shares of Apple are a textbook illustration of the reproachable activity. In other words, the popular definition of a financial pyramid is wrong. Which is right then? This one. Ponzi pyramid is a financial scheme with a fatal disbalance between trust and intrinsic value. Any investment project has an element of trust and an element of intrinsic value. Sometimes there is more trust, sometimes there is more value. In the Ponzi pyramid, intrinsic value tends to be zero. Trust takes all the space. Trust that the price of the asset will go up and only up. Why does the price have to go up? No answer. Only passionate belief. This disbalance between trust and value is the only explanation why in all financial pyramids the price initially goes to the skies due to the massive FOMO, fear of missing out, and later collapses to zero because there are no more buyers left. Now we are ready to learn the rule of pyramid detection. It consists of a simple question we must ask every time we want to invest our money in a new DeFi project. Does the new project promise a yield which is based on its productive activity, or is this yield based on pure trust? For illustration purposes, I suggest we get back to the sad story of the Terra blockchain and its two tokens, stablecoin UST and its stabilizing token Luna. Throughout the whole year, the Terra ecosystem boasted the highest return for a stablecoin in DeFi, 20% APR for a simple staking. Just imagine that you come to a local bank, deposit your dollars, and the bank pays a 20% APR. The Terra ecosystem was home to a lot of fancy business, but nothing in this business came even close to profitability, which could justify such immense return for investors, 20% APR. Where then did this number come from? 20% APR came from the head of Terra's founder, Korean entrepreneur Doc Won. He declared this yield with the only one goal in mind, to attract as much investors' money as possible. No wonder the entire construction collapsed with the first signs of panic in the Terra ecosystem. Both tokens, UST and Luna, lost all their value, and the investors saw 60 billion of their dollars evaporate within several hours. Now, a hardball question. Did I know that the Terra ecosystem did not produce enough to justify the 20% APR for staking stablecoin UST? Of course I did. Just like numerous other traders who lost on this deal. Then why did I invest? The approach is called money management, on which I'll elaborate in a moment. Now let's have a look at a crypto project which gives us a positive answer to the pyramid detection test. A decentralized exchange named Platypus operates in the Avalanche network and promises 2.7% APR yield for lending of stablecoin USD. In this case, there is no need to worry because this number reflects the exact amount of fee Platypus collects from all transactions in which this very stablecoin USD is involved. We see that in the case of Platypus, the promised yield is fully justified by the real productive activity of this crypto platform. I understand that it's hard to learn right off the bat how to apply the rule of pyramid detection and to tell good projects from bad ones. But have no doubts, as your experience grows, you will sharpen your skills to the point where you will be able to get to the core of profit mechanisms of a new project after just 5 minutes of reading its documentation. The knowledge of where the money comes from will immediately show you the right balance between trust and value in the project you consider for investing. In the meantime, until you feel yourself experienced enough, I recommend to shun completely all new DeFi projects, let alone the ones whose profit mechanism is beyond your understanding. A rule of thumb in this decision-making could be a simple rule of 6 months. Just ignore all DeFi projects which don't have at least half a year's presence in the market. Block 17. Money Management Main Principle. The second component of our magic formula of success in DeFi is good old money management that everybody has heard of, but almost nobody uses in their practice. There is a huge variety of technologies of different degrees of complexity which allow to fight effectively almost any financial risk. However, I'm confident enough that for such a simple market as crypto, one money management principle will suffice, at least for the beginning. Here it goes. Never ever invest in a single position more than 5% of your capital. You can literally fall in love with the project. You can admire the founder. You can be fascinated with the originality and inventiveness of the financial principles used, but please, I implore you, never ever put more than 5% of your eggs in a single basket. This very principle is the trick that saved the portfolios and nerves of professional investors in situations similar to that of Luna and UST. This simplistic money management rule does real wonders. Whatever happens to any of your investment position, a hacker broke the code of the smart contract and stole all the money from your liquidity pool. The price of your token dropped 99% in the open market. Impermanent loss wiped out all the good tokens from the pool and left only bad one. Whatever bad thing happens, your loss will never be higher than 5% of your money. Nowadays, the common yield in DeFi is so high that the investment positions which remain afloat will generate cumulative profit capable of covering in excess any losses coming from the unfortunate investments on the condition they don't exceed 5% of total capital each. Believe it or not, but we have come to the end of our primer of DeFi theory. Now we're ready to begin our practice. In the second part of our Express course, there will be 3 short blocks of information. Block 1. Workplace setup. In this block you will learn where to find all necessary information regarding every key aspect of DeFi. which Web3 plugin wallets should be used in DeFi together with your main hardware crypto wallet, how to switch between crypto networks in MetaMask Web3 plugin, how to transfer tokens from one crypto network to another. Block 2. Working with a yield farming optimizer. We will follow step by step the entire algorithm of depositing liquidity in a stablecoin pool at one of the time-tested and reputable decentralized exchanges. And later we will move the received LP token to a vault in another yield farming optimizer. Block 3. Lending in a capital market platform. We will follow step by step the entire algorithm of depositing liquidity in a lending pool at one of DeFi capital market platforms. Now then, to work. Part 5. DeFi practice. Workplace setup. In the first practice block of the Alphaleaks Express course, you will find all the necessary tools to begin working in DeFi. We will start with the key information sources. CoinGecko is the best place to obtain statistics regarding the current state of practically all existing cryptocurrencies and tokens. For convenience of operation, please switch the interface to the language of your preference. CoinGecko informs you about the latest market quotations, price, trading volume occurred in the latest 24 hours, market capitalization. Once you click on the name of the crypto assets, you gain access to additional data. Circulating and total supply, website link, Explorer's location. Explorer is a web interface for accessing any state of the blockchain on which the specific crypto asset is deployed. A list of all software and hardware wallets capable of supporting directly that particular crypto asset, links to all related social media, and more. Beside the information on crypto assets, CoinGecko provides data on centralized crypto exchanges, decentralized ones, and exchanges for derivatives. DeFi Llama. The next portal we use intensively is DeFi Llama, where we can find information relating to the crypto networks serving as platforms for smart contracts, decentralized applications, and all types of DeFi. We start with the section Chains, which gives access to a list of all existing DeFi networks. Clicking on the name of any network opens the window containing general statistics regarding TVL, total value locked in the specific network, calculated in US dollars. Beneath, we see the list of all DeFi projects deployed in the respective chain and ranked by TVL. Clicking on the name of any project opens additional information concerning the time dynamics of TVL changes, a briefing note on the project, and links to the website and social networks. The menu item Categories arranges all major DeFi projects by their type. DEXs store information on all decentralized exchanges. Lending is what we used to call in Alphaleaks capital markets, that is the platforms where we can lend, collateralize, and borrow crypto assets. Bridges are web portals for relocating assets from one DeFi network to another. CDP, short for collateralized debt positions. This is a variety of capital markets where we can use our assets as collateral for borrowing locally minted stablecoins. And 23 more types of DeFi projects. Clicking on any category opens the list of all DeFi projects belonging to the respective type and ranked by TVL. The stablecoin section provides important information on the most valuable part of DeFi, since it deals with assets with minimized market volatility. In this section, we can find a comprehensive list of stablecoins ranked by their capitalization and accompanied by the iconic view of all DeFi networks in which the specific stablecoin is deployed. For example, an algorithm stablecoin called Frax can be interacted with in Ethereum, Phantom Opera, Moonriver, Arbitrum, Polygon, Moonbeam, Avalanche, and 9 more smaller DeFi networks. DeFi Llama contains a plethora of additional interesting stuff which will become useful to you should you decide to delve even deeper into DeFi. Coindex. The next portal I use literally daily in my DeFi practice. Coindex, the best place for discovering the most profitable investments in DeFi at any given moment. In the section Top Stablecoins, we can find precious real-time data concerning DeFi projects that promise the highest yield on investments made in stablecoins, which are resistant, as we know, to market volatility. One thing that relates to the concept of yield is extremely important to understand. Despite the fact that the yield in DeFi is always shown as APR, annual percentage rate, which disregards compounding of interest, or APY, annual percentage yield, which includes compounding, the word annual doesn't imply that we are guaranteed the same percentage of yield all through the entire year ahead. The yield in any DeFi position constantly changes, not daily or hourly, but sometimes even every minute. This is due to the fixed rate of rewards which are distributed among the investors in a pool or vault. The more TVL a specific position attracts, the smaller the yield becomes, if calculated per $1 of assets invested. The mutable nature of the yield in DeFi suggests that before making an investment, one should have a look at the dynamics of its rate. Just click on the name of any stablecoin, let's say on USDC, which at the moment promises an exorbitant return of almost 40% APY. This yield is being generated by the project Virus Finance in the network Waves. Virus Finance is a capital market platform which allows lending and borrowing of crypto assets. Accordingly, the rewards are paid for staking in the lending pool of USDC stablecoin in this particular network, Waves. If we consider the yield dynamics chart, we will see that it demonstrates quite a stable return within a narrow range between 39 and 44% APY, at least since mid-April. Now it's the perfect time to bring back what we have learned about the risks of DeFi and apply our rule of projects which are too good to be true. We can look around and see that lending stablecoins at the overwhelming majority of rival capital market projects promises at least 2 times lower yield than Virus Finance. This is a major red flag, which urges us to stay away from such dubious offers. Another section of Coindex, DeFi, gives us access to a wealth of precious information regarding over 5,500 crypto assets deployed in DeFi at the moment. Here we can see both mono assets like ETH, USDC, wrapped ETH, and composite assets like Frax3 CRV or DAI USDC, which are constructed of 2 or more tokens. The most common type of composite asset is LP token, which we receive as a certificate for providing our tokens to a liquidity pool in one of the decentralized exchanges. For example, let's look at USDT/USDC LP token. This is a composite asset representing a liquidity pool deployed by the project called VVS Finance in the network named Kronos. At the moment, there are $345 million worth of stablecoins in this pool, which consistently generate almost 10% APY, at least from the end of February. By default, all assets in the DeFi spreadsheet are ranked by TVL. But as soon as we click on any column, let's say on APY, the entire list will be rearranged in accordance with the annual percentage yield the DeFi projects generate. We can also apply various filters to this spreadsheet. For instance, we can limit the information to one or any number of networks only. Let us select DeFi projects deployed exclusively in Avalanche and Phantom networks. Next, we will try to limit assets to certain types, let's say stablecoins only. If we wish, we can search for positions which involve just one specific token, for example, algorithmic stablecoin named Frax. Next step could be minimal yield we want to have. Let's make it more than 5% APY. Finally, let's search only for the pools which control at least $100,000 worth of assets. Here, we change TVL to more than 100K. As a result of all the filters applied, we can see that at the moment there is only one liquidity pool in the Avalanche and Phantom networks that meets all the conditions. That is, AlgoCoin fracs to be involved, annual percentage yield higher than 5%, and total value locked in the pool more than $100,000. Our choice is the Vault Frax USDC, which belongs to one of the most popular and reputable yield farming optimizer called Beefy, and this vault is deployed in the Phantom Opera network. Debank. The next indispensable source of information to our work in DeFi is the web portal called Debank. In my humble opinion, this is the best place for obtaining a summary of all positions which belong to a given crypto address and are deployed in the most popular DeFi network. This kind of functionality is called dashboard. In order to use the Debank dashboard, we can either connect our crypto wallet to the service or just type in any address we want to analyze. Let's try this. In the section Wallet, we see all the assets that don't participate in DeFi at the moment and are simply stored passively at the address. Below, we can see a list of all DeFi platforms together with a list of all active positions the analyzed address has opened up till now across various networks. In our example, it is SpookySwap, the biggest decentralized exchange in Phantom Opera, and it holds only one open position, that is a liquidity pool for the pair BTC-ETH, that's Bitcoin and Ether. Web3 browser extensions for DeFi. We have agreed that the private keys that unlock our crypto assets should be stored preferably in hardware wallets, Trezor, Ledger, or SafePal. The thing is that in order to interact with DeFi protocols and smart contracts, we need an additional piece of software in the shape of a browser extension capable to interpret Web3 commands. Such Web3 extensions can connect to our hardware wallets and simultaneously interact with DeFi networks and the smart contracts deployed there. It is important to note that throughout this interaction, our secret keys continue to be securely stored in the hardware wallet, and Web3 browser extensions never have any access to these keys. Since the last topic of our discussion was Debank, it is natural to mention that the same team has also developed, in addition to a great dashboard, probably the best Web3 browser extension for working in DeFi. It is called Rabbi and is accessible for download from the Debank homepage. Before Rabbi appeared on the market, the only standard we had for Web3 browser extensions belonged to the product called MetaMask. Today, MetaMask is inferior to Rabbi practically in all respects. The only reason to continue using MetaMask constitutes the interaction with those few DeFi protocols which are not compliant with modern standards and as a result don't know how to interact with Rabbi. 99% of my work in DeFi happens today through Rabbi Trezor or Rabbi Ledger bundle. Nevertheless, I still have the MetaMask extension installed in another web browser, Firefox, in order to interact with non-standard protocols. This MetaMask is obviously also paired with hardware wallets. As you probably noticed, my default browser is Brave, with the Rabbi extension installed on it. In addition to Brave, Rabbi supports Chrome, both in macOS and Windows. Other browsers like Firefox or Edge or Safari are expected in the future. Even if you prefer different browsers in your everyday work, I still recommend you install Brave, at least for DeFi, for numerous reasons. Firstly, MetaMask by default supports only one network, Ethereum. If you decide to work with other DeFi networks, which you definitely should, you will have to manually input all parameters for each network separately. And there are dozens of these. Obviously, it's not a life-threatening fatigue, but the biggest trump of Rabbi is not so much the support by default of 34 major DeFi networks, but the ability to switch automatically between any network, even within the same DeFi protocol. As a result, if you have 20 different DeFi websites open in 20 tabs in your browser, you can just switch from one tab to another and see Rabbi being automatically connected to the appropriate DeFi network. Had you had MetaMask installed instead of Rabbi, you would have to manually switch DeFi networks for each of your 20 tabs. Installing both Rabbi and MetaMask is easy. You can download Rabbi directly from the Debank homepage. MetaMask is accessible via its own site, metamask.io. After the installation, we follow the on-screen instructions to connect the Web3 extension with our hardware wallet, and we are ready to start DeFiing. If you encounter any difficulties with this rather straightforward installation routine, please Google or check YouTube, since the internet is exploding with exhaustive video guides on this subject. Bridges. We continue our practice with a look at bridges. These are platforms designed for transferring tokens from one crypto network to another. There are literally hundreds of bridges today, which makes it impractical to consider them separately. I recommend using one of these so-called bridge aggregators, for instance, Decommerce. This is a central place where you can search among all major bridges to meet your specific needs. Let's try, for example, to find bridges suitable for the transfer of assets from the Polygon to Kronos network. In the field From, we type in the name of the network where we already have our tokens, that's Polygon. In the field To, we put the destination network for the transfer, that's Kronos. The Decommerce aggregator immediately finds all suitable options for this route. All we must do is to go through the list and choose the bridge with a good balance between the size of fee and the speed of execution. Let's check the first bridge in the list, EvoDeFi, and click on the Bridge button. Our first action is to connect the bridge to our hardware wallet via the Web3 extension. If we don't see Rabbi explicitly in the list of supported extensions, like in the case of EvoDeFi, you simply choose MetaMask, and in 99% of cases the connection will succeed, since Rabbi supports major standards of MetaMask. Next step, we should fill the transfer form from Polygon to Kronos, token to be transferred. We find it in the drop-down list. Let's say we choose USDC stablecoin. Recipient fields hold the destination address. By default, the bridge fills in the sender address, but you're free to change it to anything you need. In the amount field, we put the number of tokens we want to transfer. Next step, we must confirm with our digital signature all transactions the bridge needs to carry out for transfer. Each time we interact with the new smart contract, it wants us to sign two transactions. The first transaction gives approval to use a certain number of tokens involved in the transaction. This type of transaction is called approve. The second transaction asks us for permission to perform the needed action itself. In our case, the transfer of USDC from Polygon to Kronos, but it could be anything: depositing of assets in a liquidity pool, staking in a vault of a yield farming optimizer, lending, borrowing, etc. The first transaction, approve, requires our full attention right at the beginning of our DeFi journey. Historically, approve by default allows the smart contract you interact with to use an unlimited number of tokens participating in the transaction. It looks to me like a huge security oversight on the part of the inventors of the Solidity computer language that is commonly used for coding smart contracts in Ethereum and later on in all Ethereum-compatible networks. One can understand the intentions behind such unlimited approval. It spares the users from numerous repetitive approvals in the future while interacting with the same smart contract. But the dangers of unlimited approvals vastly outweigh any possible gain in convenience. Just think for a moment what you do by giving unlimited approval. You actually allow the smart contract to do whatever it wants with all approved tokens in your wallet. If anything bad happens to this smart contract in the future, like a hacker breaks it, then the same very hacker will be free to embezzle any number of the approved tokens from your wallet without the need for additional permissions on your side. Therefore, commit please to your memory. Never ever sign approvals for an unlimited number of tokens. Always change the unlimited amount to the exact number of tokens your transaction involves. I will show you how to do it in the very next practice block when we will work with the bridge transferring tokens from one network to another. Blockchain explorers. The last part of our Workspace setup deals with blockchain explorers, special web interfaces which allow users to monitor all changes happening to the blockchains of crypto networks. Almost all networks have at least 2 or 3 different explorers. You can find their names on general information portals like CoinGecko. I will limit my demonstration to Ethereum and 5 more networks that are best suited for starting our journey in DeFi due to their good balance of fee and speed. Etherscan is a benchmark explorer initially created for Ethereum and cloned later by almost all competing networks. FTM is a blockchain explorer for Phantom Opera. Snowtrace is a popular blockchain explorer for the Avalanche network. BSC Scan is another proud clone of Etherscan designed to work with the BNB chain. SolScan is an official explorer for the Solana network. Polygon Scan monitors the changes in the states of the Polygon blockchain. In each and every explorer, we can trace in real time everything that's happening in the respective blockchain. We can check the status of any transaction, whether it succeeded or failed or is still in the process of execution. We can analyze any detail of any transaction, the sender address, the recipient address, the token and its amount, smart contracts involved, etc. We can study the contents of an address to determine which currencies and tokens it holds, which DeFi positions are kept open, which platforms are interacted with, etc. We can get real-time information on the current load of the network, speed of adding blocks to the blockchain, size of gas. Gas is a unit that measures the amount of computational effort which network nodes apply to execute certain operations and smart contracts. Okay then, I assume we already have a preliminary idea of how the workspace in DeFi should be set up. Now we're ready to proceed to some real work. In the next practice block, I will give you step-by-step instructions on depositing liquidity in a stablecoin pool at one of the time-tested and reputable decentralized exchanges, and later move the received LP token to a vault of another yield farming optimizer. In the final practice block, you will learn how to deposit assets to a lending pool at one of the DeFi capital market platforms. Working with the yield farming optimizer. Before we start working in DeFi, we must buy cryptocurrency for fiat money, dollars, euro, pounds, etc. There are hundreds of different ways to finance our future DeFi activity, but all of them can be divided into 2 venues: centralized crypto exchanges and P2P exchanges, where buying and selling is done directly between users. I've explained in the beginning of our course why I dislike centralized exchanges. That's because they require users to undergo the KYC, Know Your Customer procedure, a mandatory identity verification that implies going through biometric facial recognition, uploading utility bills and pictures taken in front of your passport or driver's license. The biggest problem with KYC is not in its humiliating nature, but in the fundamental security breach. Suffice to say that centralized crypto exchanges leak customer information on a regular basis, resulting in a flood of clients' happy smiling faces posing with their passports put up for sale at all darknet criminal marketplaces. With all that said, the fastest and cheapest way to do the first purchase of crypto assets today is still by using centralized exchanges. You open an account, top it up with fiat money using a simple debit card purchase, and buy some native DeFi blockchain cryptocurrency. Then withdraw all your crypto assets from the centralized exchange to the personal wallet that you control with your own secret keys stored in your Trezor, Ledger, or SafePal. The most comfortable centralized exchange to deal with outside of the US is Binance. Within the United States, it's Coinbase. The second venue to introduce funds into DeFi is by using P2P exchanges. These are just as numerous as centralized exchanges, although it's easier to name the best. These are HODL and Paxful. You can easily find on YouTube detailed information on how to use centralized and P2P exchanges. In the meantime, we will concentrate on more upscale knowledge of productive DeFi. The essential requirement for work in DeFi consists of having a small amount of native cryptocurrency in a network before we start doing anything there. If we want to work in BNB chain, we have to fund our address in this network with cryptocurrency called BNB. For Phantom Opera network, we need FTM. For Avalanche, we need AVAX. For Polygon, Matic, etc. You already know why we need native cryptocurrency as our very first step. That's because all transactions in any network require gas, that is payment for computational efforts of the nodes, and the gas is always paid in native cryptocurrency. Once you have your address funded with native currency, you can exchange some of these tokens to any other asset using a local DEX, decentralized exchange. Considering the above, we are ready to set general frames for our further actions. 1. On any centralized or P2P exchange, we use fiat money to buy cryptocurrency of any major DeFi network: BNB, Matic, AVAX, FTM. 2. We withdraw that currency to our personal crypto address in the respective network. BNB goes to BNB chain, Matic goes to Polygon, AVAX goes to Avalanche, FTM goes to Phantom Opera. 3. We swap some of our native cryptocurrency to any other token we might need for a given DeFi investment. This swap happens at any of the local decentralized exchanges. 4. In case we want to expand our operations to another DeFi network, we transfer a required asset from the network where we already have it to a new one. For this transfer, we use one of the special platforms called bridges. I will start our practice from the point where I already have Matic cryptocurrency at my address in the Polygon network. Let's say I want to invest some stablecoins, which, as we know, don't depend on market fluctuations, in a liquidity pool at one of decentralized exchanges operating in the Phantom Opera network. After that, I want to optimize my yield in another place, that is in a vault, which belongs to a yield farming optimizer in the same Phantom Opera network. Let's look at the steps we need to take in order to reach our aims. 1. We go to the information website we already know, Coindex, and search for the most attractive investing opportunities for stablecoins in the Phantom network. 2. We choose liquidity pool MIM USDCLP at the Sushi Swap exchange. 3. We create MIM USDCLP at SushiSwap. 4. We deposit MIM USDCLP at Beefy Finance. Now I do it all step by step, watch closely, and try to understand each action. If I want to invest in the MIM USDC liquidity pool, I will obviously need these two stablecoins, MIM and USDC. I can buy MIM later, after I relocate some funds to the Phantom network. While in the Polygon network, I can exchange some of my Matic tokens onto USDC stablecoin, let's say for 100 USD. For the swap, I can use any reliable decentralized exchange on Polygon. I will use QuickSwap. After the exchange, I will relocate all USDC from Polygon to Phantom using one of numerous bridges, Synapse protocol. Its main advantage is the ability to receive, together with the exchange token, a small amount of Phantom's native currency, 0.4 FTM. As you remember, without the native blockchain's currency already present in our account, we cannot do any transaction in a new network because the gas, payment for nodes' computational efforts, is always paid in this native currency. We always have to substitute the unlimited approve with the sum which equals the exact amount participating in the operation. Now I'm ready to exchange half of my USDC amount into the second stablecoin I need for the liquidity pool, that is MIM. I will use a popular multi-chain decentralized exchange, SushiSwap. This is the same DEX I will use for investing in the USDC meme liquidity pool. After the swap, I can see roughly equal amounts of USDC and meme at my address in Phantom network. I also have some FTM to pay for gas. It means I am ready to deposit both stablecoins into the desired pool. We always have to substitute the unlimited approve with the sum which equals the exact amount participating in the operation. After the second transaction receives a confirmation, my address is credited with an LP token. This LP token serves as a certificate stating my investment in the particular liquidity pool, USDC meme. As a next step, I want to optimize my yield using one of the popular cross-chain optimization platforms named BeFi Finance. I find the corresponding liquidity pool, choose option Deposit, check meme USDC SULP, that's for SushiSwap LP token, click on Max, button Deposit. In a new approval transaction, I again change the unlimited amount to the exact number of LP tokens I deposit into the optimization BeFi vault. I confirm the second transaction, that is the deposition itself, using my Trezor hardware wallet. Modern DeFi protocols are already highly advanced, and that allows us to use various approaches to reach the same result. For example, I could easily skip the first two steps of the above algorithm. That was the purchase of meme stablecoin and deposition of both USDC and meme into the liquidity pool at the SushiSwap platform. Instead of this, I could create the final position directly at BeFi Finance. And I could do that with the help of only one token, USDC stablecoin I transferred from the Polygon network. For this magic, there is a special functionality implemented by BeFi Finance called Zap. Here I choose Deposit, then check USDC option, click Max, button Deposit, change approval from unlimited to the amount of my USDC tokens I intend to deposit into the vault, confirmation of the second transaction using Trezor hardware wallet, done. The missing actions were done by BeFi's decentralized application. It took my USDC stablecoin, exchanged half of it onto meme, went to SushiSwap, deposited both tokens there, took the LP token, and deposited it into its own vault to create regular auto-compounding of yield farming rewards for us. All that DeFi magic happened behind the scenes for our convenience. Well, we are done here. I have invested my stablecoins into USDC meme liquidity pool and later optimized this investment with the help of the Beefy Finance platform. Now I expect to see great revenues without the risks of exaggerated market volatility which plague regular crypto assets. Now it's appropriate to remind you that the APR and APY percentage numbers we see at all DeFi platforms are not static and depend fully on the filling of investment pools, and that should be par with your expectations. These yield dynamics encourage the users to constantly monitor their positions in DeFi and optimize them occasionally. By optimization, I mean closing of the pools and vaults with drastically decayed profitability and shifting capital to other platforms and maybe to other DeFi networks, which at that moment demonstrate a sufficiently high return. In the next practical block, we will learn, among other things, how to search for these high returns with the help of CoinDex portal. Lending in a capital market platform. In this practical block, I will show you how to deposit liquidity in a lending pool of one of the DeFi capital market platforms. Let's set the general framework for our further actions. The first step is similar to what I did while searching for an attractive investing opportunity in a liquidity pool. Now I go again to CoinDex and search for profitable lending. This time, however, I will fish not in the Phantom Opera network, but in Avalanche. Let's set up filters for the search. Left tab on top, DeFi, Avalanche, AVAX, network. Select the stablecoin option. And adding one more filter, TVL, total value locked, should be higher than $1 million. Double-click on the column APY for sorting the results based on the return. The first position in the list is a regular liquidity pool which belongs to a DEX called TraderJoe, and it consists of two different incarnations of the same stablecoin, USDC and USDCE. The second position is staking of the USDC token on the C-Bridge platform. C-Bridge is a bridge, and that explains the source of the return in this position. One stakes USDC in a reserve pool, which provides liquidity for the transfers of this stablecoin from various DeFi networks to Avalanche. The yield in C-Bridge offers a good investment opportunity, but for the sake of this tutorial, I will look further down the list and search for an investment in a lending protocol, as was our initial intention. The third position belongs to Stargate. That's an asset relocation platform which functions similar to a regular bridge but uses different and more sophisticated mechanics. Next two opportunities belong to the insurance pools of a platform called Insurace. And finally, we see what we were looking for. That's the pure lending platform called Banky. The staking of the USDT stablecoin offers a modest return, but this lending pool definitely enjoys large confidence and trust since it has already attracted more than $2 million. If I was coming after common sense, I would definitely prefer investing in the C-Bridge reserve pool or Insurace insurance pool over Banky. But as in this block, we are looking into dealing with capital markets and lending, which are the most popular area of DeFi. For demonstration purposes, I will stick with Banky. Now, before I invest USDT in Banky on Avalanche, I need to exchange some of my Matic tokens into USDT stablecoin and then relocate this stablecoin from Polygon to Avalanche. For the exchange, I will use the DEX we already know, Quick Swap. For the relocation, I will also use the bridge, Synapse protocol, for the same reason. This nice bridge sends, together with the exchange token, a small amount of the blockchain's native currency. This time it will be 0.025 AVAX, which will be enough to start operations in this new network. Now we are ready to invest USDT in the respective lending pool at Banki. Left tab Markets. Choose token USDT from the drop-down list. Amount max. Approve and deposit. I assume that substituting the unlimited allowance with the exact amount of investment has already become our second nature. After the confirmation of the second transaction, we wait for a while until we see our position being shown in the lower part of the screen as supplied assets. That's it. We successfully invested in a lending pool with Banki Capital Market platform on Avalanche network. The last trick I will show is how to unwind any of the DeFi positions. The moment you decide that you want to leave a liquidity pool, vault, or any other staking position which has no time lock, you can do it easily in a reverse sequence. As an example, let's unwind our staking at Banki, since I don't like its yield either. I go exactly back to the same place where I created the initial position, find in the list of my investments, in case there are many, the one I want to quit, click on it, and select option Withdraw. Then max, confirm a single transaction, and within several moments my USDT stablecoin returns to my wallet. Well, believe it or not, but we have reached the end of our Alphaleaks DeFi Express course. Before turning to say goodbye, I would like to remind you that we at vCollege plan to release regular updates to our Alphaleaks course. In each of these updates, I will introduce you to 3 new, most interesting and promising DeFi projects which will establish themselves on the market. I wish you all success in a newly discovered exciting world of DeFi and hope to meet you soon online.